Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. We are smack in the middle of the week as also the sixth month of 2025, and Nifty seems to be caught in a narrow 200-300 point range where 24,700 appears to be the base, and at an 8-month high, the Nifty is unable to cross 25,200. Global crisis is upon us. There is a war in the Middle East. Crude oil prices are spiking up. Gold and silver are up as well. And many asset classes, including equities, are showing signs of stress as also signs of profit booking. We are now joined by Mr. Amit Goel, co-founder and chief global strategist at Pace360, to decipher the road ahead and where exactly should one be putting in money at this point of time. Namaste Amit ji, and a very warm welcome to you, sir. Paint for us a picture of sentiment on Dalal Street. How do you see the market in context of the crisis that's happening between Israel and Iran in the Middle East, as also crude oil prices topping to Jan 2025 highs?
Firstly, thanks for having me on, Shail, and it's always a pleasure to connect with you. So, Shail, my understanding is that in the very, very near term, it's possible that markets be in a sideways zone. And if you were to ask me what that range could be on Nifty, for example, I think 24,200 on the downside and 25,400 on the upside is the range that I would think we are in. And right now we are bang in the middle of this range. And my sense is that as far as the small caps and mid caps are concerned, there the overvaluation concerns are going up by the day. They've had an extraordinary rally in the last 1 month. So 15th of May, Nifty made a high, multi-month high of 25,100 odd. And Nifty from that level is still down more than 1%. But if you look at the journey of the small cap and mid cap in this last 4.5, 5 weeks, then they have gone up a mighty lot. So small caps is up by something like 10%. So my sense is that there is a regime change happening in the markets right now. And small cap and mid caps are now looking extremely, extremely, I would say, overburdened with the rich valuations. And plus, there has been a lot of retail buying in small cap and mid caps over the last 1.5 months. So that is looking very, very overbought and under the weather. But if I were to talk about Nifty or Bank Nifty, I'm not so pessimistic there, at least for the near term, because I believe we are in a range. And I think my understanding of the geopolitics is that the Israel-Iran situation is right now close to its worst. It's not going to get much worse because neither US nor Israel are looking at regime change at this point. They just want to neutralize their nuclear capabilities and their ballistic missiles capabilities. And I think that target can be achieved within the next week to 10 days. So my sense is that crude oil prices, which are very elevated right now, Brent is at 76. My understanding is that we are close to the peak for crude oil prices. Maybe we go up to 1 to 2, 3%, but there is not much upside. On the other hand, there is a potential downside as soon as the market begins to feel that the Iran-Israel situation is now not getting worse. It is incrementally getting better, and which is what I expect is going to happen over the next 2 weeks. That will give a reasonably good bounce to Nifty, and Nifty can actually make a new multi-month high at 25,400. While small cap and mid caps, while the action is going to be largely stock specific, but on the index level, I'm not at all positive there. And on a longer term basis, I would say that once these geopolitical issues are sort of sorted out and they are discounted and the next quarterly results are in, I'm very, very bearish and pessimistic on the equity markets for the longer term. But in the very, very near term, I think there is a bit of extra potential upside to the large cap indices than the potential downside. But I would say that the situation is probably reverse for the small and mid cap, where the potential upside is probably smaller than the potential downside in the near term. But longer term, I unequivocally maintain my view that this is going to be a pretty heinous bear market, which is going to unfold over the next 2 to 3 years.
Okay. And how is the client portfolio at Pace 360 trying to capture this negativity?
So basically, what we are doing is that we have brought down our equity stake in the PMS by a huge margin between April and now. So on every possible upside, we have been selling, and
Okay.
now our equity percentage is now less than 12%.
Okay.
And this also we would probably sell over the next 6 weeks by, let's say, by the mid of August, once the quarterly results are in largely. And we are getting healthy gains from our fixed income portfolio, which is shaping up well because the yields are down and the spreads are tight. So our corporate bond portfolio and our government bond portfolio both have done extraordinarily well over the last 1.5 2 months. So I would say that while we may have missed some of the gains in equities over the last let's say 4 to 5 weeks, but we are totally committed to our viewpoint that we want to conserve capital, we want to make money from fixed income, and we would buy equities only when there is a some sort of a sharp fall or a wave of panic. And with the geopolitical situation the way it is and the way the Trump administration is shooting on all sides and angles, I think the next panic is never too far away. So my sense is that we will get opportunities every few weeks or every couple of months. We will get opportunities to dip our toes in the in the water, pick good quality stocks, and then sell them when the situation normalizes. So this is the
Okay.
exactly situation that we are in at the moment, Share.
So 12% is equity. How much is corporate bond and government securities as a percentage of overall portfolio?
Corporate bond would be about 70 odd percent, and government bonds and a bit of gold, where we have not booked profits yet. So that would account for the remaining 18 to 20%. So this is where we are at the moment, and we've got between April and between March and May, we had a pretty decent bounce in the market, because of which we were able to bring down our equity from 95% to 12%. So I guess the portfolios are in good shape, and we are very, very hopeful that we would be able to navigate through this geopolitics, through this bear market, which probably lies ahead of us.
Okay. Just an aside, Amit, out of this total portfolio, if I remember last year the number was 1000 crores, right?
Yes, it is upwards of 1,000 crores at the moment. It would be close to 1,200 to 1,300 crores at the moment.
Okay. How much of it is client money? 50%?
The client money is definitely more than 50%. So the client money would be at the moment be about 70 to 75%
Okay.
of the overall corpus, and rest of it is close family and relatives.
Fair point. So, 700 crore rupees, you say, is in the ratio of about 88% bonds gold and 12% equity. Am I right? Ballpark.
Yes,
Okay. Now,
yes.
let's take this discussion forward
Ye-
once we have this base in our mind. What's the average yield to maturity for the corporate portfolio, corporate bond portfolio?
The yield to maturity there is about, at the moment, it is about 11%. And these are very high quality bonds. So we do not foresee any sort of default or downgrade risk in our bond portfolio. And we've been a big player in the bonds market over the last 25 years, and we are pretty confident that we will be able to navigate through these very, very tricky times. So that is about 11%. And we are sitting on government bonds, of course, where the YTM when we invested was about 7.45%, and right now, of course, it would vicinity of 6.25, 6.3%, and rest is, of course, gold through sovereign gold bonds.
Okay. So, for the 88% that you just described, I am presuming that the average yield will be closer to 9.5 10%. Am I right? Minus gold, because gold is a
Yes. Yeah.
is an asset where you're looking at capital appreciation as well, right? So my point, Amit, is that aren't you aiming lower in a market where we've just had a major rate cut, a major burst of liquidity, and the fact that SIP inflows continue dramatically, and you are at 12% equity. I'm just asking, as a strategist, what are you thinking?
That's a brilliant question, Shell. See, we are extremely skeptical of what's going to unfold over the next 2 to 3 years.
Okay.
So, this corporate bond portfolio that we have is basically a parking facility for us, and this is not a long-term investment for us. And I can assure you that if we get the opportunity like we got in March and then again in first week of April, we would be the most aggressive AMC in the country in picking up stocks, because we would start from a point where our exposure to equities would be so low that we would be able to ramp up our exposure from, let's say, at that point, our exposure is less than 10%. So from probably less than 10% to 60, 70, 80%, we would be able to ramp up in very, very short period of time. So my sense is that over the next 3 years, between our corporate bond, government bonds, to some extent gold and equities, where our strategy would be hit and run, buy when chips are down and there is blood on the street, and sell when the equity markets normalize. I think we should be able to comfortably clock between 17 to 18% per annum, Shell. And if you look at the staunchest of bulls on Dalal Street at the moment, and I completely agree with you on all the positives that you mentioned about SIPs and rate cuts and everything. But let's bear in mind that even the staunchest of bulls are wary of the valuation levels. Nifty at 22 valuation, Nifty next 50 around the same, and mid cap and small caps median and mean valuation somewhere in the 30s. This is an extraordinarily expensive market. Even the staunchest of bulls in the market are not talking about a more than 10% to 12% return over the next 3 years. I think we should be able to clock 17 to 18%, irrespective of the fact whether the bull market remains or it's a heinous bear market, which is my base case. So if I'm able to return to my investors 17 to 18%, while the equity markets go down by 10, 20, or 30%, then my cumulative alpha over the next 2 to 3 years is going to be more like 60, 70%.
Yeah.
So I would any day compromise on 2, 3, 4% of incremental returns to secure my cumulative alpha of 60 to 70%, which I foresee is going to happen over the next 3 years.
You know, Amit, I have half a mind to take you out for dinner tonight and grill you on this logic of the market falling 10, 20, 30% from here, which we shall do. We shall do that shortly. In the 12% portfolio that you have in equities, how is it spread?
So it's basically what we did that predominantly we sold all our small caps and mid caps,
Okay.
whatever we had. So now this portfolio is entirely, and it is entirely, let's say, stocks where we are very comfortable with the valuations. There is no there is no defense stock in this. There is no overvalued sector or stock in this. So these are all large caps where the average valuation, the average P ratio would still be below 15. So this is where we are. So it's a very, very safe portfolio, and we are absolutely committed to bringing it down from 12% to low single digits within the next 6 to 7 weeks, which is when the quarterly results will be in. And whenever you would wish, I can delve at length on why we expect this bear market to unfold. It's a view which is completely seeped in macroeconomic data points, trends, and tea leaves that we see at the moment. And we would be more than happy to share with you and your audience and viewers as to why we think that's going to.
Okay. Okay. Fair point. I think we are going to have a very interesting conversation fairly soon. That will be off the record. We'll discuss uh, the broad characteristics of this bear market, that this incoming bear market that you talk about. Now, as far as precious metal is concerned, Amit, how do you see this very sharp rally that's happened in both gold and silver? Both of them are up 35% year to date. In fact, more on gold than on silver. Uh, is this something that you feel will continue? Are you trying to add silver also to your overall mix?
Shell, we are not looking at adding silver at this point. Uh, we have seen a good run in silver, and I think it may continue for some more time. So I would not be surprised if silver from $37 it goes up to 38 or 39. My absolute top at this point, which I perceive in silver, is about $40, which is about 8% higher from the current levels. As far as gold is concerned, I think it peaked out on 22nd of May at $3,500. I see very little value in gold at this point, Shell. And there are many reasons for that. I think the jewelry demand is plummeting on gold, and the ETF buying has slowed down, and the central bank buying is also, it has also slowed down. So if you look at the Chinese central bank, which has been the elephant in the room as far as gold is concerned, they've just added 2 tons of gold in the last calendar month, which was May. So my sense is, Shell, that at the current prices, there is excess. So gold was in kind of a deficit situation till last year because the demand was pretty robust, particularly investment demand and demand from central banks. But the supply was not picking up. But now the supply has picked up. Gold mining is now at an all-time high. Gold recycling is at an all-time high. On the other hand, jewelry demand it has gone down. And just look at the psyche of the Indian consumers, who are, of course, the biggest buyers of gold as far as jewelry is concerned. And if you had a budget of 10 lakhs for jewelry, for gold, till 2 years back, that 10 lakhs would have got you lot many more ounces than what you will get today. So if you spend the same amount, then the number of ounces that you end up buying is like 30-40% lower share. So
Okay.
I think the demand supply equation of gold has gone awry. And over the next 6 to 8 months, I see a 15-20% correction in gold. But longer term, I am very bullish on gold. As far as silver is concerned, in the short term, it may go up a little more. But when the bear market unfolds, which is what I expect, then silver being more of an industrial commodity today than a precious metal, I see silver going down a lot over the next 2 years. years. But I think as of now, it is in a bit of in a happy situation where it can extend its rally.
Okay. So, short term, we are bearish on gold, on silver, on equities, long on bonds, and just a bit of equity there. And no cash in the portfolio, Amit?
No cash, Shell, because we are a multi-asset fund house. So if we are not finding opportunities on equities or gold, there is no way that we would keep the money in a liquid fund or a fixed deposit. Uh, we believe that we have packed enough experience in the bond market over the last 25 to 28 years that we can get for our investors a 300 to 400 basis points higher than the liquid fund return, or maybe even higher than that, through our corporate and government bond investment and trading. So there is never any cash in our portfolio at any point of time.
Okay. What's the uh, what's the amount of time in terms of days will it take for you to empty out the bond portfolio if you were
Shell,
to go
as
down to zero?
let's say, God forbid, and I would obviously not want that as a as a citizen and as a human being. God forbid thing drastically goes wrong and equities were to tumble over the next, let's say, few days. It would take us not more than 2 weeks max to bring the corporate bond portfolio to pretty much zero. So that's our runway, Shell. It's about 2 weeks, out of which 50% we can probably liquidate in a week's time, and the balance 50% in another 1 week's time. So we've got a relatively short lead time for us to be able to convert our bond portfolio into other asset classes if we see an opportunity. But I do not think that equities are going to tumble from here, because I do feel that the current geopolitics is well discounted there. The crude oil prices are well discounted there. So I personally do not see much of a downside in the very, very near term. But of course, longer term, as I mentioned, I have a lot of concerns on the global economy and the stock markets. And I would be more than happy to share with you all the reasons.
Yes, we'll be meeting fairly soon to discuss what those concerns are. Amit, thank you so much for your time. And before I let you go, I've always believed that in the world of markets, it's gentlemen who prefer bonds. So here's to one on the screen. And thank you so much for your time. And let's hope that the bond portfolio gives you fantastic returns now that the rate cuts have been front loaded and you have flush liquidity in the banking system. Have a nice day, and we'll be meeting soon. That, ladies and gentlemen, was Amit Goel, co-founder and chief global strategist at Pace360. An unusual construction of a portfolio at a time when a wide swath of the Indian markets are bullish. Amit has 88% of his portfolio into corporate bonds, government securities and gold, and the remaining 12% in equities, of which the PE, the average PE of those 12% equities in the overall portfolio is less than 15. He is foreseeing a bear market in India, and given the geopolitical concerns and the fact that there is a lot of volatility in the market, he prefers the relative safety of bonds over equities. I hope you enjoyed the conversation as much as I did. There's a lot that's happening on Business Today Television. Stay glued.
प्रधानमंत्री मोदी और राष्ट्रपति ट्रंप की मुलाकात G7 समिट की साइडलाइंस पर होनी तय थी। राष्ट्रपति